Hi, my name is Conor Quillette. I'm Chief Economist here at Davy, and I'm here today to discuss our note on the promissory note deal that was done last week between the Irish Central Bank and the European Central Bank. So what the deal does is to effectively extend the term of ECB monetary finance to the Irish government from about an average term of 5-6 years under the old deal to a new term of 15 years. So the Irish government is going to issue new bonds. These bonds will have a floating rate fixed over Euribor, but the Central Bank of Ireland, when it's forced to eventually sell these bonds, will have the option to turn them into fixed rate bonds to make them marketable, and we certainly expect them to do that. Now, the holding period that the Central Bank of Ireland has agreed for these new bonds, the bonds themselves have a 34-year average maturity, but the Central Bank is allowed to hold them for 15 years. That means any excess interest over and above the Central Bank of Ireland's funding cost of 0.75%, the ECB refinancing rate, any excess interest on the bonds will accrue to the Irish Central Bank and then back to the Exchequer. So the ultimate funding cost, 0.75%, or whatever the ECB rate happens to be, that's been extended from maybe 5-6 years to around 15 years, and that's a significant interest saving. And we think it will add on average, will reduce debt interest costs by around 800 million on average between 2013 and 2030. Most of those interest costs come in the later years after 2020, when under the old arrangement all of the cheap ECB funding had been due to be run down. In the short term, those interest savings will be much more marginal, around 200 million in 2014 and 2015. In addition to those interest savings from extended cheap ECB funding, there's also the black box of IBRC. A lot of money went into IBRC for capital purposes to help pay down central bank funding support, and we didn't really have a very good idea of exactly how those flows of income flowed through. The official government estimates indicate that there's effectively $1 billion of interest payments that will be saved from IBRC, but these are payments that would have always ultimately accrued to the Exchequer because the state owns IBRC. Of course, to offset that extra $1 billion that the official estimates indicate is likely to happen in 2013, there's the costs of liquidating IBRC, principally a $1 billion charge under the eligible liabilities scheme. So that will offset any benefit in 2013. In addition to that, assets of IBRC will have to be written down as they're sold, perhaps by the liquidators, or if they're eventually transferred into NAMA. And of course, that extra $1 billion that the official estimates have, 0.6% of GDP, that doesn't include any charge as those assets are written down, or if extra capital has to go into NAMA as the assets are transferred across. So again, over and above that 800 million on average over the next 17 years, the sort of extra 1 billion the Department of Finance has indicated, that doesn't include any charges for liquidating NAMA. That said, certainly there may even be residual capital left on IBRC, and that could actually benefit the Exchequer. So overall, still very uncertain in terms of what that benefit will be after IBRC is wound up. So for more on this, please see our website at www.davy.ie.